Hi, this is Greg Remke. This is part two of a presentation on money, banking, and finance for the STOA topic. Uh, I do workshops in the summer and the fall on the debate topics and speak at camps and also give talks at debate clubs. This is just an online version of some of the presentations. I ended the last session talking about the dramatic loss in value of the US dollar since we went off the gold standard. And then later, President Nixon closed the gold window, Motel 6, Game of Life. If you look at the Ethos Debate website, they have a number of cases. Bring back the gold standard, which could be bring back commodity-backed money, regulating cryptocurrency. Fannie Mae and Freddie Mac. Freddie Mac are the government or quasi-government home mortgage organizations that critics say expand and distort home loans in a way that is systematically unstable for the financial system, leading to the housing crisis in 2008, derivatives market crashing, and so forth. And now we have those back again. So privatizing would turn these into private companies that provided these services. And other cases that they advocate, and I'm happy to try and answer questions if you have them about these or other cases that you run up against in debate. They also have generic briefs. And again, many economists are critical of banking and finance regulations, both on the left and the right, arguing that they're too much or not enough or the wrong kind of regulation. Federal student home loans, there's a lot of evidence and debate cases on this from last year's topic for the NCFCA League, which was on higher education. The argument is by subsidizing student loans, we're distorting the loan market, loading up college students with enormous debts, and pushing the cost of college education much higher than it would otherwise be. So there's an argument for getting the federal government banking and finance system out of subsidizing student loans or guaranteeing student loans. So one of the websites, as a background on the topic, Ballotpedia, has pages on the Federal Reserve System, giving a background of the history of it, how it is, how it works. Also, the Federal Reserve banks themselves have lots of economic education materials and information about the monetary policy and the history of the Federal Reserve System. Of course, they tend to, present a positive view of the Federal Reserve. But it's valuable and scholarly information. Ballotpedia website showing the Federal Reserve banks across the United States, concentrated in the East because when the Federal Reserve was set up, the districts, most of the people were in the East, so that's where the banks were. So it's pretty crazy that we just have one bank in the West, but that's the way the system was set up. How might affirmatives reform the Federal Reserve? Well, they could end payments on deposits. After the financial crisis, the Fed injected vast amounts of money into the banking system, quantitative easing, various levels of it to try and stabilize from the financial crisis. And then they tried to sterilize or to make sure that money didn't cause inflation. So they started paying deposits or started paying payments on deposits that banks had. So in essence, the Federal Reserve is paying banks not to loan money, right? If they keep excess deposits, which in a sense makes them safer, but it also means that money isn't available to loan to businesses and others, and they're actually earning money for not loaning money, which I wish I could earn money for not loaning money. So the question is, why should the banks be doing that? Private citizens can. A bank pays us for putting our money in our savings account, but why should the Federal Reserve be supporting banks this way? Another reform of the Federal Reserve is to say, instead of just making decisions ad hoc on the views of the banking executives at the Federal Reserve, instead it should be a rules-based system. Milton Friedman argued this. The money supply should grow as the economy grows. And so the money supply decision should be made sort of automatically by a computer rather than just being arbitrary, whatever the Federal Reserve officials decide under pressure from Congress or the president. So the Taylor Rule is named after John Taylor at Stanford University. He has a very good economic education website, online economics course. But the Taylor Rule is a formula that he developed that basically is widely regarded, highly regarded as a rule that would stop the Fed from creating too much money or not enough money. Because blame on the past financial crisis has come from the Fed being too easy money, too much money, or too restrictive when the money supply falls precipitously. Another Federal Reserve reform is to end the Community Reinvestment Act, or to reform it. And this is a piece of legislation that calls for the Federal Reserve and other federal banking regulators to push banks to make loans in their community. So if a bank is in a community and people have checking accounts, savings accounts from that community, the bank is supposed to reinvest that money in the community. That all sounds reasonable, but pressuring banks to make loans to people who wouldn't otherwise qualify for loans is a distortion of the banking system. And so it sort of politicizes it. You have NGOs that are constantly suing banks for not loaning money in a way that represents the ethnic diversity of the community. But borrowers should be able to borrow money on the basis of how strong their credit is. And that decision is made by somebody. The claim is banks are racist by not loaning to Hispanic Americans or Black Americans or some other group. But if it were the case that there were significant profit opportunities for loaning to a particular ethnic group that's discriminated against, there would be banks and finance companies eager to do that. There's lots of African American owned banks, Hispanic or Latino owned banks. They would make money by loaning to people who are credit worthy that other banks don't. So the claim that the federal government has to step in and look for discrimination and regulate, this ends up with politically pressuring banks to make loans they otherwise wouldn't, at the fear of being sued by NGOs and others, and having the Community Reinvestment Bank as a club to enforce these things. The argument is this contributed to the financial crisis in pushing banks to make loans that they otherwise wouldn't have. So again, and that's the claim from, let's say, conservatives or market advocates. There's more on this online on the Federal Reserve website about what the CRA, the Community Reinvestment Act, is. And then there's the regulators, FDIC, FRB, OCC, the agencies that regulate banks, and you can see a problem already. You've got a bank trying to do business, and they've got to deal with three separate federal regulatory organizations, as well as state and other organizations, as well as community groups that are litigating to pressure them to make these and those loans. So that means you have to have compliance officers and a lot more overhead. It makes it harder for banks to do business. Now, on the other side, here's NPR with a segment saying, look, the banks need to make more loans to minority people, that finance companies and others that are decentralized around the country, they need to be forced to make loans to less qualified or minority borrowers. So this is an argument for expanding the CRA to capture more financial institutions. So it's valuable to see different claims on this. If you eliminated the whole thing entirely, then banks would have less overhead, less bureaucracy, and again, money is still available to people in the community from a whole bunch of innovative lending agencies, new online companies. The claim that people can't get money because big banks won't give it to them is antiquated, critics argue. Okay. The argument is banks are cherry-picking rich customers. Sure, they want to loan money to wealthy customers. They seem most likely to pay it back. Part of this narrative of big bad banks and that helping the rich and not helping the poor and bankers with their big cigars. This is a long history in the U.S. and the world. Part of it's anti-Semitism, part of it's just anti-bank, anti-capitalism. But it's good to know where these views come from. So the New Yorker had a long-form essay, The Invention of Money, that talked about the history of finance and banking. So there's a long history citing scholars, marvelously written as usual for the New Yorker, and worth reading to get a sense of the background of banking and finance and money. However, American Institute for Economic Research argues that the New Yorker article is way biased in their perspective on this, the history they chose to present. And so they give egregious errors in the New Yorker's account. So you have, one side saying, here's what we think about banks, here's how government should regulate them to solve these problems. And then you have economists at AIER, a pro-market organization, saying, here's what's wrong with the New Yorker perspective. So again, more reading for background on the topic. For the critical view of just ending the Federal Reserve, getting rid of it, that may sound radical. Ron Paul wants to do that, Rand Paul wants to do that, but who else among bankers wants to do that? Well, it turns out a lot of economists think that the Federal Reserve either is poorly managed or shouldn't exist at all. And here's a presentation, I don't know why that spins like that. Here's a presentation by Lawrence White, who was in the first session, on just why we should end the Federal Reserve. And he says, here's what the Federal Reserve does, this, and this. Here's how these things used to be done without the Federal Reserve, and to some extent are done today without the Federal Reserve, or done in other countries without institutions like the Federal Reserve. And the things that are unique to the Fed that the private sector couldn't do are damaging. So he says we're taking a real risk by having the Federal Reserve. It is destabilizing the banking, finance, and monetary system. So again, different perspectives on the Fed. I'm going to skip over the video. You can watch it. This is an article with a link from George Gilder. And by the way, these links, if you click on them in the PDF of the overheads, they might not work. You have to copy and paste to get both lines of the URL. But Gilder's saying, look, we do have a financialization of the economy. The Federal Reserve and the fiat money system have destabilized things in key ways that require banks and companies to do a lot to try and accommodate that, and that hurts the economy, that hurts the middle class. And you can read his book online, you can read the review. There's some videos on the scandal of money where he describes the story. And I show a few minutes of the video online. Or at my workshops, I'm going to skip over it here. But the links are again in the overheads. Okay, thank you very much for watching this first presentation, part 2 of this first presentation on banking, finance, and monetary policy.